The second statement we're going to look at is the income statement. This is important, and most people look at the income statement as their primary or first statement they examine. So let's slow down. So there's a top line and there's a bottom line. You probably heard these terms before, like what is meant by this. So a top line is this. It's the top line. It's the first line. It's revenues, right? So the first thing you want to know is how much did they sell? And it's called net revenues because it's going to be net of things like returns or allowances, but primarily think of it as money that you charge to your customers and they paid you, right? That's what revenues. Then we jump all the way to the bottom to get to the bottom line. The bottom line is net income. This is how much profit you made. So in this case, is Under Armour. It's great that they sold $3.9 billion, but what if all of that was used up in all their expenses and their costs to run the business? Then they make zero. Well, it turns out they didn't make zero. They made the bottom line of $232 million. So now we see the big difference between revenue, which is the revenues, the sales you had, and your profit, which is called net income. And the things in between are just what you had to pay to provide the products to your customers and to run the business. So what we do in accounting is there's a lot of structure and we have a lot of subtotals. So look at the next subtotal. The next subtotals here is called gross profit. Gross profit is net revenues minus cost of goods sold is gross profit. So if we're Under Armour and we're selling a shoe, the revenue for the shoe is $100. The cost of making that pair of shoes is, let's say, $30. So revenues are 100, the cost of goods sold is 30, so their gross profit is $70. So that means that $70 is available to pay for all their costs of running the business, and hopefully there's left over for profit. The next section that we see has another subtotal, income from operations. So income from operations is, okay, pay all your bills for running the business. In this case, they're called selling, general, and administrative expenses. Pay all your bills of salary, rent, insurance, all that. Now how'd you do? Did you make any money after you paid your bills? Answer here, yes, they made $400 million. Thank you very much. So after that, there are things that are non-operating, right? So interest expense is not for running the business. Interest expense is because you happen to borrow money. You could have sold stock, but you borrowed money. So there's interest expense. Then we get another subtotal right here, income before taxes. So income before taxes says, okay, after you pay all your bills and after you pay your bankers, now how much money did you make? So that's before you pay your taxes. And then you have taxes and net income. So what we've done is shown 1, 2, 3, 4, 5 lines. The top line, revenue, gross profit, which is how much you made after just the cost of providing your product. The third is operating income, which how much money did you make running the business. The next is pre-tax income, which is how much did you make prior to paying your income taxes. And net income. After everybody's paid, everyone got their money, did you still make money? And so this is the income statement, and that's why people look at it so carefully, because it tells them a lot about how the company is doing. So the other part is expenses. We talked about SG&A. So what are the kinds of expenses we'd see? The first expense level is right there, cost of goods sold. That is the direct cost, in this case, of making the tennis shoe. SG&A are your operating expenses, and this would include rent or salaries or insurance or marketing. And then the third would be interest expense. This would be money you pay to your banker for the use of their money. And finally, the other expense is taxes. And this is how much you pay income tax to the Internal Revenue Service in the US for your business. So this is how these relate. Now, all these are looking at one income statement. So we can look at top line, bottom line. We can look at subtotals. We can look at where the cost, where does the money go, right? They're all shown on this one fairly innocent looking statement. So let's summarize, is that money that we got from our customers is total revenue. And then our costs are these items that cost us to run our business. And then the bottom line is net income. So this is what we want to look at when we look at income statement. So we're going to be doing quite a bit of analysis on income statements because, as I mentioned, it tells us a lot about the economics of the company. So the so what here, we did so what on balance sheet. Now we're going to do it on income statement. So there, here again, when we array different industries and companies, we see net income as a percent of sales. So when we see something like a ratio as such, just think in your head, is a higher number better or worse? So if we had net income as a percent of sales of say 20%, that means for every dollar of sales we make 20 cents. That sounds pretty good. Well, that's where Apple is, right? We all know how profitable Apple is. So Apple has a very high, what we call net margin. So for every dollar of sales, they make a lot of money. Then we go to the other end of the spectrum. We have Macy's and CVS. These are retailers. Nordstrom's, Macy's is like Nordstrom's. It's a major department store chain. CVS is a pharmacy chain. They sell many things other than just prescription drugs, but these are retailers. So Apple selling $1 is going to make a lot more money than CVS or Macy's trying to sell in a retail business, just higher cost to do business in retail. Net income as a percent of sales, and another example of a ratio analysis, tells us a lot about a company. Now, if we looked at one industry, let's just pick one in the middle, just for example, is Southwest Airlines. So Southwest Airlines makes, it looks like they're making about 12%, let's say. You can, instead of just looking at Southwest compared to Apple and CVS, you can say, okay, let's look at only airlines. We'll look at Southwest, United, JetBlue, etc. And we compare the profitability by the same measure, net income as a percent of sale. Now, how do we look? So this is a very good measure that does comparative within an industry where you can't say, oh no, we're not Apple Computer. No, you're not. You're an airline, just like Southwest. Now how are you doing? So this is an example when we do within an industry the same ratio, and we're able to gain insights about an industry. So this is again an example of how we use the data now to compare different competitors in one industry. All right, our next statement is the statement of stockholders' equity. And this is where did the funding come from the owners. And as mentioned before, there's two ways for that to happen. One is they give you money to buy stock. This is called, in accounting terms, contributed capital. Makes sense, right? It's contributed, not like a donation, but it's contributed to the company by its shareholders. That's selling stock. Second is they let you keep their money. They keep the profit. That's retained earnings. So this is, again, an example of Under Armour. And so we have there, over a one-year period from 2014 to 15, there are changes in stockholders' equity. And we have categories like contributed capital. That's how much they sold in stock. So during the year, they issued $22 million in stock, and they had retained earnings comprised of net income minus dividends, which was zero. And then we have other equity, which is this item of $30 million, which is something we call accumulated comprehensive income, OCI. And so this is something that we're going to look at, and it's quite technical, so I won't delve into AOCI very closely now. But I'm just going to keep it at the level of you get money in the company by two ways. One is by getting people to buy your stock, and the other is to earn profits and keep the money. That's the answer. And we see that on this particular basis using Under Armour as our example. Okay, so the next is to say the so what. Now here what we look at, as we mentioned, we have two approaches, contributed capital, and we're looking at things like, did we sell more stock or did we buy back stock? And companies do both. Companies that are very successful have money not to burn, but they can't deploy it very well, so they buy back their own stock to lower the amount of capital that investors put in. And so companies like Apple or Microsoft would be buying back their stock to supplement the dividends and giving return to their investors for having the trust in their business and the investment in their business. The other is retained earnings. So this is where we say, did we earn money this year? And then the second is, did we pay dividends? So retained earnings is equal to the net income. So I'll just kind of highlight that here. So retained earnings equals net income minus dividends. So that's it. Here, the three things to know is stock transactions are contributed capital, profits and dividends are part of retained earnings.